All right, well, the latest Royal LePage pricing survey out this morning finds that home prices in the GTA continue to lag. So aggregate home price nationally rose by 3.8% in the fall of last year over the fall of 2023, with prices in Toronto seeing a bit of a drop. So for a look at what these numbers are telling us, we're joined live this morning by Phil Soper, CEO of Royal LePage. Phil, always appreciate your time. Thanks for being here. So let's talk about these numbers here, the lag and the drops in Toronto. What does that say about this market in particular?
Well, it's really a condo story. The detached section is attracting lots of interest, detached section, in the fourth quarter and into the new year. But we have a substantial supply of condos. You could call it a temporary oversupply, and that's pulling overall or keeping house prices overall from appreciating at the rate they should be, given the amount of activity in the market. We finished the year with sharply higher activity.
So do you separate out the condo market and take a look at the detached, like the single detached home, and sort of take a look at the differences there, Phil?
Yeah. So, for example, in 2025, we believe that we'll see overall home prices in the GTA up about 5% by the year end 2025, but condos will be essentially flat during the year, and it'll be a steadily climbing session with home prices in 2025 as we see the Bank of Canada easing rates.
Yeah, no, I was reading your note last night, or your release. It says that you're expecting rates may drop by another 100 basis points, so a full percentage points this year. If that doesn't happen, Phil, how much of an impact could that have on the market? Because there does seem to be that expectation, if not appetite, from certainly home buyers, that the rates are going to be dropping.
Sure. It is a very rate-sensitive part of the economy, housing. And most serious forecasters believe that the Bank of Canada wants to get rates down to what they call a neutral zone, where they're not stimulating the market, nor are they acting as a drag. Today, at the current rate, it's still a bit of a drag, much less so than when the rate decline process began. It's down 175 basis points, 1.75 percentage points. So that's very material, but it's still got a ways to go. So yeah, it would impact housing in general, particularly for first-time home buyers.
Yeah, I mean, you and I, talked our way through all of those numbers over the past couple of years. That's for sure, Phil. In the meantime, there's the other wild card here. We've got what's happening south of the border with Trump tariffs, kind of the wild card element to that unpredictability. But then here we know we're going to be seeing a federal election at some point, likely in the spring, maybe even a provincial election as well. How could those factors have an impact on the market?
The Trump trade war obviously is the biggest threat to the Canadian economy overall. But for housing is a very domestic industry, particularly in what you might call the short or medium term. It's Canadians buying and selling products, property among themselves. We've had a foreign buyer ban in this country for an extended period of time now. So it's not that we export housing or we import housing. So it would take some time. It would have to impact employment. It would have to really hammer consumer confidence before it would impact housing. Now, the domestic election could directly impact the housing industry. For example, the capital gains inclusion rate that the current government increase in tax there that the current government had on the table. If the government was to change and a new government changed that could actually help, for example, the rental sector where we need investors.
Okay, we'll be watching it very closely throughout the year. Phil Soper, CEO of Royal LePage. Happy New Year. Good to see you again.
Thanks, Nick.